Hey everyone, welcome back to Corporate Dakota, the place where we decode the secrets of big business, and today we're diving into Macy's latest moves, and let me tell you, it's all about making it rain, but with debt. Before we dive in, if you appreciate getting clear insights from these corporate filings, make sure you're subscribed and don't forget to join our Discord community for more discussions, linked right in the description below. Alright, so on July 14, 2025, Macy's announced a pretty significant financial maneuver. They're issuing a cool $500 million worth of new debt, specifically senior notes that pay a rather chunky 7.5% interest. Think of it as borrowing a huge chunk of money with a promise to pay it back, with quite a bit of extra cash on top. These notes are due way out in August of 2033. Now, this isn't Macy's themselves borrowing directly, but rather a subsidiary called Macy's Retail Holdings LLC. However, the parent company Macy's Inc. is giving a solid guarantee, meaning if the subsidiary can't pay, Macy's itself steps in. This is pretty common when companies want to ring-fence certain operations or debt. The deal is expected to close by the end of July, assuming everything goes according to plan. So why this big borrowing spree? Well, the money is earmarked for some pretty specific purposes. It's going towards two main things: a tender offer for some of their existing older debt, and then a redemption of even more of that old debt. Think of it like a financial reshuffle. They're essentially paying off some of their existing debts with this new, possibly more expensive debt. This tender offer is essentially Macy's asking its bondholders if they're willing to sell back their existing bonds, likely at a premium. Then they're also planning to redeem, which means they're calling back and paying off a significant amount of other existing debt. It sounds a bit like they're trying to streamline their debt, maybe get a better interest rate overall, or perhaps push out their debt maturity dates further into the future. The crucial part here is that these debt paydowns are totally dependent on them successfully selling these new $500 million notes. If the new debt offering doesn't go through, their plans to pay off the old debt might also fall apart. It's a bit like building a bridge with one end anchored only when the other end is successfully built. Now, there aren't any detailed financial tables showing revenue or profit directly in this particular filing. This is a current report focused on the debt offering announcement. Normally, you'd find the juicy financial numbers in their 10Q or 10K filings. What this report does point us to is a press release from July 14th, which we can imagine contains more details about the offering. This filing is pretty much confirming the announcement and providing the official record for regulatory purposes. So what's the story here? Macy's is actively managing its debt. They're issuing a significant amount of new debt, not to fund new growth or a major acquisition, but to pay off existing obligations. This isn't necessarily a bad sign on its own. Companies often refinance their debt to get better terms, lower interest rates, or more favorable repayment schedules. However, the fact that they're issuing debt at a rather high 7.375% interest rate could suggest a couple of things. It might mean that the market views Macy's as carrying a bit more risk now than before, or perhaps interest rates in general have simply risen, making all new borrowing more expensive. It's important to remember that Macy's, like many traditional retail landscape, facing stiff competition from online giants and changing consumer habits. This debt issuance, while aimed at improving their financial structure, also increases their overall leverage. More debt means higher interest payments, which can strain cash flow, especially if sales don't keep pace. It's a delicate balancing act for the company, managing debt effectively while investing in strategies to stay relevant and competitive in a tough market. Overall, Macy's is making a strategic move to refinance its debt, which could be a positive step towards financial stability if managed well. However, the elevated interest rate and the sheer amount of debt being managed are definitely points to watch. We'll need to keep an eye on their future filings to see how these new debt obligations impact their overall financial health and if they can successfully reinvest in their business to drive future growth. Alright, that's our quick decode of Macy's latest financial announcement. What's your take on this debt strategy? Are they playing it smart or taking on too much risk? Let us know your thoughts in the comments below. If you found this breakdown helpful, give it a thumbs up and subscribe so you don't miss our next deep dive. And remember to join our Discord community linked in the description for more insider discussions. Thanks for watching. Corporate Dakota out.